Hello, everyone. This is Dr. Duru from Ahan Analytics with the market breadth. Well, the month of August ended on a pretty flat note, but there are some signs of exhaustion, particularly in big cap tech, that have caught my attention. Still, my short-term trading call is neutral because I see a balance of risk in the market, but mostly everything is acting bullish. Let's take a look. This is Swing Trade Bot. Again, I'm a subscriber, big fan. It's an excellent stock scanning tool. You could see here that the major indices are all short-term flat. The Russell in turn of fate is actually still up. It's usually been lagging the other major indicators. Um, and if you look at the different technical indicators, you wouldn't necessarily know that there's some signs of exhaustion underneath the hood. I mean, new highs is very bullish relative to new lows. The bullish and bearish signals are relatively balanced. I mean, a few more bearish signals. Advancers, there's more decliners than advancers. So maybe from there you might raise an eyebrow and wonder what's going on. But this is the big one, the heat map. This heat map is a great tool because with a very quick glance, you can see all of the red concentrated on big cap tech names. You can see that here under technology services and electronic technology, even consumer durables. And there's also an interesting set of red right here. This is the producer manufacturing. Look at all of that red. This one really got me nervous. And I'll show you the chart of Caterpillar. I jumped into a put spread on that, and I'll explain to you why in a second. So these heat maps are very good tools for kind of teasing out what's really going on underneath the hood, besides, of course, market breadth, which is my favorite way of looking at the market, or at least starting to look at the market. I won't cover the rest of these items here. Let's just jump right into the charts. Like I said, market breadth is where I like to start. I call it AT50 for above the 50. It's the percentage of stocks trading above their 50-day moving averages. I'm going to go to regular here. You can see that AT50 pretty much was flat for the week. There was a little bit of churn, but it's definitely cooled off. And still this overbought level at 70% is teasing us. So AT50 ended the week at 64%, 64.8%. So it's just in range within overbought, but it's not quite breaking out. And the longer it fails to break out, the more nervous I will get. Let's take a quick look at AT200, which is the percentage of stocks trading above their 200-day moving averages. This one looks a little bit more encouraging because while it churned, it did gain a little bit on the week. Oh, sorry, no, it closed flat on the week, but at least there was a intra-week uptrend, and it still looks ready to burst out to higher levels. So AT200 closed the week at 60.5%. All right, let's go straight into the indices and then individual stocks. So the S&P 500, like I said, just pretty much a blah week. It kind of churned, went to all-time high. Let me move that over here. It had an all-time high just yesterday on Thursday and then had this 0.6% drop. I forgot to mention the big news, I think, was earnings. NVDA was the big earnings news, and there were a lot of other big earnings movers in tech in particular. And then we also had the PCE, which is the personal consumption expenditures index, which is the Federal Reserve's favorite inflation indicator. It is still showing sticky inflation, and we're going to go dive right into cutting rates, even as inflation remains well above the Fed's target and remains sticky. I've written about this on my Inflation Watch, drduru.com blog, so you can see more there. All right, so that's the S&P 500, pretty much flat. You can see the uptrend is still in place. The 20-day moving average has been holding up relatively well throughout this bounce from the April trauma, drama, and noise. And certainly the 50-day moving average and the 200-day moving averages are pointing upwards. We have the same thing for the NASDAQ. The NASDAQ, all of the major support lines are holding and trending up, sorry, and the 20-day moving average is still holding, but the NASDAQ had a bigger loss today, 1.2% down, and you can see here that just last week it had trouble holding 20-day moving average support. And again here, back at the end of July, sorry, the beginning of the month, it had a similar problem. So This is what I mean by big cap tech in particular showing to me just these subtle signs of exhaustion. So we just want to keep an eye on this. And then IWM, the iShares Russell 2000 ETF, amazingly is outperforming on a relative technical basis because it's well above its 20-day moving average, which is this dotted line, and it held like a champ on the last test earlier this month. Actually, I think this is last week. I am long some IWM call options, and I forgot to mention I am hedging some of my bullishness with S&P 500 put option spreads. In fact, I opened up a new one today. Okay, let's dive into the individual stocks. So, of course, NVIDIA captured all the headlines today. First sign of potential exhaustion. I drew this what I'm calling a subtle double top. Like, some people would look at this and say, wouldn't see the double top. I do see it because I'm trying to find out what's really going on under the hood. And of course, NVIDIA was just at all-time highs. It's beaten out all sorts of bearish technical setups. So this is probably another one it's going to beat. But notice how close the 50-day moving average is to NVIDIA, ticker symbol NVDA. The 50-day moving average is this red line. Today it dropped 3.3%. I believe this is related to Alibaba announcing that it's going to create its own AI chips to replace the ones that it can't get from the US because of regulations. And that, of course, is going to open up probably, it could open up a flood of Chinese chips. Sorry, I should say Alibaba specifically, but I'm sure other companies in China will also start to produce their AI chips and significantly cut off a potential place for NVIDIA to grow. And if that happens, NVIDIA's growth prospects could turn very dramatically. And since so much growth is baked into the valuation of NVIDIA, if the growth slowdown, if any kind of growth slowdown really materializes for NVIDIA, I expect it to drop fast and deeply. Not trying to scare anybody, but I'm just saying that's the thing to watch out for when we see this subtle double top and the 50-day moving average uptrend looks like it's going to get tested. And today, you can see here, look down below, ever since NVIDIA reported earnings, we've had 3 high volume down days. So these are all warning signs to keep an eye on. I don't have a position in NVIDIA. I'm not short, I'm not long. I'm just keeping an eye on it as part of the indicators that I'm worrying about. Meta Platforms, as you may have noticed it on the heat map, is another one that's got me worried. I know I've created some worries. I've indicated some worries before, but Meta Platforms, ticker symbol META, has basically drifted right back down into what was the previous all-time high. When it gapped and crapped above this, gapped above and then crapped below, I saw that as a warning sign. And then earnings, of course, popped up 11%. But it looks like people are slowly but surely taking profits in Meta Platforms since this earnings. So notice how this, let me zoom in a little bit here. Very important juncture here. Now the 50-day moving average support is converged. So actually, I am interested in taking a trade on Meta. So if it breaks down below this converged support, then it's bearish and I want to get some puts, or I may just short the stock. If it rebounds off of this, I'm going to consider it to be very bullish under the circumstances, and I'm going to want to chase this stock with call options and or shares. Okay, I mentioned Caterpillar as being a leading problem in the producer machinery. I think that was the name of the category. I just call it industrials or manufacturing. And you can see here, I drew another double top, potential double top for Caterpillar. And what happened today? Well, it dropped 3.6%. This is called 3.7% on news that that Caterpillar upped its tariff impact. I forget the exact percentages, but it was significant enough to cause concern for Caterpillar and then to cascade throughout the entire sector. Because if Caterpillar is facing unexpectedly higher tariff costs, other companies in the same sector are going to experience that. And I suspect other companies in adjacent sectors are also going to are going to see unexpectedly higher tariff costs. And this right now, companies have been doing a great job of absorbing these tariffs. I don't know how they're doing it, whether they're just reducing their margins and or laying off people or what have you. But at some point, these companies are going to reach their limits and they are going to pass these on to consumers. So we're seeing very slowly the tariff related impacts start to percolate into areas that are very visible for investors and soon for consumers. All right, let's jump into the next one is, oh yeah, let's go to CrowdStrike. This had a very bizarre. CrowdStrike is ticker symbol CRWD. This is a cybersecurity software company. Very bizarre. It was down as much as 7% last night after earnings. It opened, look at this beautiful, beautiful technical support. It opened right at the 200-day moving average, which is this blue line, and then proceeded to just soar the entire day for a quick, an impressive reversal of 4.6% gain. But then today it reversed sharply, 4.1%. I could not find any news to explain any of this volatility. So all I can think is that investors are just very nervous, and this also makes me a little bit wary. So for CrowdStrike, very easy technical levels to watch out for. A breakdown below the 200-day moving average or a breakout above the 50-day moving average. Simple as that. Duolingo is another one of these that has been bouncing around, but it looks like the resolution is to the downside and bearish. I've already covered Duolingo in previous video and on my blog. So all I'll mention here is that this 7.7% drop on high volume is just confirms the bearishness. Look at this downtrend in Duolingo since its all-time high. I think this is back in May. So the next important support, the Duolingo is definitely bearish. So the next important support is here from April. Let's just call this around 289. And if that breaks down, then the next support is 271. And if that breaks down, forget it. Duolingo is probably topped out for the foreseeable future. Um, so that's the technicals to watch there. Let's take a look at Etsy. Etsy, I don't know why it took me so long, but Etsy has gone from very strong to weak because of the expiration of the de minimis rule that allowed importers or exporters, however you want to call them, whatever direction you're looking at, to have duty-free products if they were under $800. And so I totally forgot that, of course, Etsy is full of small-time retailers and sellers, and a lot of their products are under $800. They're going to face increased costs. So either they're going to make less money or they're going to have to pass that on to consumers, and that's probably going to suppress demand for some of these specialty type products. A lot of them are arts and crafts type products that are very discretionary, and people are probably very price sensitive on those. So you can see here Etsy has been just wildly bouncing around, and now it's testing its 200-day moving average. So very critical point here. I gave up. I had some calls that went quickly to zero, but I'm giving up on trying to chase this trade around. I'm just going to step back and just keep an eye on the technicals. So if it breaks down below this 200-day moving average, Etsy goes into official bearish territory. Another bizarre post-earnings reaction was in Elastic, ticker symbol ESTC. They provide, basically, I'm just going to call it internet infrastructure software. And I'll leave it at that. And actually, I should say computing infrastructure software. So anyway, you can see that ESTC has not really, it's just chopped at an extremely wide range. And today, though, it gapped up. In fact, yesterday after reporting earnings, it was up something like 15%. Don't quote me on that. And it gapped up above its 200-day moving average and then proceeded to sell straight down. I went ahead and took a speculative call option spread on this because again, I'm looking for the news. The headline earnings look fine, but I didn't see what would explain this reversal. And it just could be my news sources aren't thorough enough. So anyway, I took a speculative position on that. We'll see what happens. Um, Snow had a pretty good day yesterday on post earnings. Snowflake, sorry, is basically a database platform, and you could see that let's see, it almost, oh yeah, it did surpass the last high from early 2024. So now Snowflake is all the way back to where it was trading 3.5 years ago. So that's pretty impressive, but it still has a long way to go to get to all-time highs. It's still a relatively expensive stock, but I do think that the 20% post earnings gain is very bullish for Snowflake. But of course, the warning is that as we've seen with other stocks, profit takers have moved into other situations where the post earnings move looked very bullish. So I think it's encouraging for the bulls that Snowflake closed so far up above its Bollinger Band, which is the black line, but still held on a little bit on Friday. The other big database company, software company that had a huge move, and it's even more bullish than Snowflake, MongoDB, ticker symbol MDB, soared 38% on Wednesday. And then buyers weren't done. It took it up 7.6% on Thursday. And finally, today was a day of rest. Now, the irony with MongoDB is it too, just like ESTC, has gone pretty much nowhere for a long time. Sure, it's given some excitement to the upside and downside, but it essentially hasn't gone anywhere since 2020, and maybe, depending on how you're counting, back to 2019. So it's a very expensive stock, and maybe it's just absorbing, growing into its valuation while it just churns all around like this. But the good news for buyers or holders is that these two strong updates is very bullish for the prospects of um, MongoDB. So next week for earnings, I'm looking at Phreesia, ticker symbol PHR. I've written about them on Seeking Alpha. I'll just say that as I predicted, it did break out above this line here at $28.81. So I am a holder. I did not buy enough of it. In fact, I didn't buy any stock when it was down here. I just kind of left it as a very tiny position, but I'm very happy where it is now, of course, and particularly given that my prediction did eventually come through, sorry, for the stock. But now it's got earnings next week, so I'm on the edge of my seat. I'm going to hold on and see what happens. Phreesia provides software for healthcare institutions, and there's a lot of different features to it. Okay. Let's see what. Oh, Hormel. Oh my goodness. So way back during the pandemic, I joked around about how Hormel would be a better buy than Beyond Meat because I called it beans over. Um, I think I said get your protein from beans or something like that. Anyway, but Hormel, man, supposed to be a defensive stock. It crashed 13.1% yesterday post earnings. That took Hormel all the way down to oh gosh, I have to go to the weekly version on this. Took Hormel all the way back to prices last seen in 2015, maybe 2014. Absolutely incredible. You could see that Hormel was a long-term winner for quite some time. And that's why I bought into Hormel several times. Actually, I traded in and out of it after the pandemic. But now the stock looks like it could be going into a secular downtrend. So it's had this secular uptrend for decades. And this is pretty much the longest period, I believe, of weakness that it has had in decades and maybe ever. So this marks a very disturbing or troubling change in fortunes for Hormel. So, if I held the stock, I actually would be selling it here and I would wait for at least, I wouldn't get back in until at least it got back into this trading range here. So Hormel Foods Corporation, ticker symbol HRL, sells things like a lot of canned foods, basically, like beans. And I love their beans, but it looks like it's falling out of favor. Okay, other discretionary, consumer discretionary, well, really retail. So I've been talking about Dollar General and the discount stores. It looks like the fun may be ending. You could see that it beat the tariff scares for a while, but it hasn't gone anywhere. Dollar General ticker symbol DG hasn't gone anywhere for almost 3 months. Looks like it's topping out a bit. It came down actually, I think yesterday was earnings, so it gapped up and then it ended almost flat. And today it dropped 2.6%. That also had an impact on Dollar Tree, ticker symbol DLTR, and it has earnings next week. But you see, Dollar Tree looks even more concerning. Dollar General looks like it's topping out, but Dollar Tree looks like it's breaking down below its 50-day moving average, and it had a 3.0% loss today. All right. Oh, I forgot. Oracle. I was talking about databases. Let's go back. Sorry. I know I'm doing a lot of context switching for themes here, but Oracle, big database provider, of course, had a very bad day today. It's already broken down below its 50-day moving average. It looks bearish. You could see this downtrend here is contributing to weakness in big cap tech, dropped 5.9%. I think this again is related to Alibaba's announcement. I mean, the trickling out of the whole AI ecosystem. The bad news is it's trickled out into other players. So I think that's what's going on there. I want to be a buyer of Oracle for the long term if it gets down back down below, say, to the 200-day moving average, but we'll see. So ticker symbol ORCL for Oracle. All right, let's do one more retailer and then we can, or two more retailers and we can bounce out of here. Okay, five below, ticker symbol FIVE. This has had a very impressive jump from the April lows. Extremely impressive. I mean, it's almost tripled in price. So this represents a massive, massive, massive sentiment swing. It survived, so to speak, earnings with a 1.7% gain, and then it gained the next day 3.9%. But today was a little bit of weakness, and we'll see how it hangs in there. But I have my eye on this just because it had such an incredible run. This is five below, ticker symbol FIVE. And then lastly, there's Best Buy, electronics retailer, ticker symbol BBY. I almost forgot about its earnings. You could see here how yesterday it lost 3.7%, but only after, guess what? Gapping up above its 200-day moving average, making it look like it had a bullish response to earnings, only to get faded hard. This is very bearish, particularly as it's back below the 200-day moving average. Now, I'm not really interested in shorting Best Buy here just because overall there's this trading range going on. So it's kind of hard, unless you want to be a quick trigger trader, it's kind of hard really to set up something, a good risk reward trade here. Okay, thanks for hanging in there. A lot happened this week, even though overall it was flat on the indices, but there is a lot going on. Like I said, I'm wary right now about the potential exhaustion in a lot of big cap tech names. It's also trickling out or cascading out to other tech names. So September could be rough. We know we have a Fed meeting. Sorry, we have an important jobs report coming up next week. That could be a catalyst, a very important catalyst. And then the Federal Reserve meeting, where it's very possible that we will get the rate cut, but then people decide to sell on the news, particularly if the bond market says, you know what? We think that short-term price rate cut is inflationary. And if bond yields rise, you can imagine there's going to be all sorts of selling in the stock market as a result. And this is all of these catalysts are very important because I just can't emphasize enough. August, September, and October are the stock market's most dangerous months based on drawdowns. And so the drawdowns that could come are just a natural part of the game. They're not necessarily the end of the world, but they are historically, these are the months with the biggest drawdowns of the year based on median and averages. Okay. Thanks again for hanging in there this long. If you have any comments or questions or suggestions, put them down below. Please share and like the content so the algorithm knows what's up. And as always, subscribe to this channel to get more timely notifications of this content. Till the next time, take it easy, and I will talk to you or see you later. Thanks a lot. Bye-bye.